Hello, Mike Swanson here. I run the website wallstreetwindow.com. This is another video in which I want to share with you some of the things I've seen and experienced in the financial market since I started out in the 1990s. And changes, I think, in the market structure that have evolved over this time since then. And I even ran a hedge fund, co-managed a hedge fund for 3 years, from 2003 to 2006. So I've seen how the hedge fund world has changed, and also the type of trading that individual investors has changed too. And both these things are going to, I believe, are going to actually have a big impact on several widely owned exchange-traded funds in the next couple of years that are going to really take people by surprise. So let me show you what I'm talking about from the very beginning. There are three structural changes that have taken place in the market since I started out in the late 1990s that actually pose a danger. I'm not saying there's a danger today or next week, but probably within the next 5 years. And it's not anything anyone is talking about. So, first of all, let me show you this. When I started out trading in the late 1990s, day trading was in vogue, and I started out as a day trader, and what people like me were doing were trading internet stocks that did a lot of trading volume, individual stocks, and we're using level 2 quotes to pick our entry and exit positions. Now, those quotes were priced in fractions, and you could see pockets of support and resistance if you paid attention to the screen. And you could see pictures, if you go back, of people with 5 monitors in front of them, and one of them would have these level 2 quotes. And I was one of those people. But something happened, I think it was around 2002, 2001, where they took away the fractions and replaced them with decimals on the level 2 screen. That made it so humans could no longer really get any useful information by looking at these level 2 screens, and it gave market makers an advantage. They saw more information on their screens. They could literally front run orders. But something even more important took place, and that is the rise of robot trading was linked with changing of the level 2 quotes into decimals. People were creating computer programs that were using this data to front run. And in some cases, they would even get the data before other people. If you could somehow create a faster internet connection or be closer to where the feed is coming from that has the data and so forth. And books have been made about that. But this has made it so the percentage of actual trading volume in the market that is occurring every single day is totally dominated by computer trading, so-called algorithmic trading. As I said, back in the 90s, it would be less than 20% of the daily trading volume, and now it gets up to 90% on certain days. And the other thing linked to this trend, of course, is the hedge fund world. Now, I was part of the boom in hedge funds because in 2002, I opened up a hedge fund with a good friend of mine, and we co-managed that hedge fund. It started in 2003 to 2006. So I got that year wrong, but regardless, we were doing this for 3 years together, and we raised $5 million. And we were trading individual stocks, investing in sectors, and so forth. And I got to tell you, it was very stressful. I found it very stressful to manage other people's money because I would worry about it. I didn't want to lose people's money, and I basically got out of it because I found it to be so stressful. The first year we lagged the market in 2003. I think we made like 1% or something like that, and the stock market went up a lot that year. So we lagged very badly. But then the next 2 years we did very well, so well that if you took those 3 years in aggregate, we outperformed the market substantially. In 1 year, we were one of the top 40 of something like 5,000 hedge funds, ranked by performance by hedgefund.net. So it was incredible year, 1 year, even though the first year we lagged badly. But the thing is that the hedge fund world has changed since the years we co-managed this hedge fund, and that change in the hedge fund world has been linked to the rise of program trading. Most of the largest hedge funds today, most of them are doing program trading. They have teams of mathematicians that create programs. Renaissance Capital is one of the most famous ones. That's the one that Robert Mercer was linked to. But this has made it so, like, I've thought every once in a while, maybe I should set up another hedge fund. But in reality, the hedge fund world has changed so much that people, the big money controlled by Wall Street and pensions and so forth, does not go, for the most part, to funds run by individuals or even a small group of individuals, but they look for giant organizations that have the hedge fund institute, like in mathematicians and teams and all that kind of stuff, and so it's a completely different world. It would almost be futile for me if I, wanted to set one up in today's environment, because it's a computer world for these funds. But the thing about it is, today, the hedge fund world has also changed because a smaller number of funds are controlling more of the assets. 95% of all hedge fund assets are held by 5 hedge funds. So it's a complete concentration of money, and really, for the most part, the money is being used with program trading. So again, here is an example of this, the combination of robots and a few hedge funds. They call them the Quant Funds. The share of trading in the market isn't just by simple computer programming, but 25% of all the shares are just coming from a few hedge funds using the computer trading. So that it's a absolutely amazing world we live in. Now, the other trend I want to speak about with you is the rise of the ETF in passive investing. So when I first started trading, there were no ETFs, and the day traders and the active traders were playing individual stocks, mostly internet stocks, because they were moving so much at the time. But ETFs came into being with just a couple of them. I think probably SPY was the first one. I want to say after the year 2000, but there was only about 500 ETFs with $500 billion in assets total, which really isn't a whole lot of money when you think of how big the entire financial system is. And this was in 2005, and today there is $4 trillion just about in money in exchange traded funds, and almost as many exchange traded funds as there are individual stocks. And individual investors, a lot of them don't even trade stocks anymore. All they do is trade the ETF, and that's a huge thing that is a part of the structure of the stock market, along with robot trading. With the robot trading, one thing you need to understand is that these robots are day trading, they don't invest, and they are guided by almost pure price action. And that's why technical analysis and charting, such things as the moving averages, the 200-day moving average, become so critical in the market environment we're in, than almost it was before. And it was always been important, but that's why there have been times when if the stock market closes below the 200-day moving average, the robots can just turn off and you can have a 1,000-point drop in the Dow. That happened in 2016 in August. It happened during that flash crash of 2010. There was a similar drop in 2011. In 2018, in February, the Dow fell about 1,000 points in a single day. Those big drops happen when the robots turn off. So that's one of the dangers of the concentration of money in being traded by computer robots. The robots can turn off and the buying in the market can vanish instantly when they do. And they do that when the market has big drops or goes through the 200-day moving average or some other critical support level. Now, with exchange-traded funds, oops, I misspelled the top, but you know what it means. The actual people owning stocks is gone to ETFs. So the ETFs now have more money in them than mutual funds, have more money in them than even individual investors do. So now, who owns stocks? Well, ETFs own stocks. And Vanguard, that's just one ETF company, owns more than 5% of the float of 98% of the stocks in the stock market. So just one ETF company owns more than 5% of the float of so many stocks. That's how big Vanguard is, but it's also how critically important ETFs are. So many individual investors have gotten out of mutual funds and put their money into ETFs because the ETFs have a smaller management fee. So many individual investors have taken their money away from their traditional stockbroker, their traditional investment advisor, and opened up trading accounts and just dumped their money into exchange-traded funds to get the lower fees. In fact, months ago, I saw, well, it may have been last year, but regardless, Warren Buffett actually was on CNBC telling people to put their money in the ETFs and get rid of their investment advisor. Not to pay the 2% management fee, but just get into the ETF and pay a smaller management fee. However, there's a few things about ETFs people do not think about at all. One illusion with ETFs is that they're diversified. They're not. And I'll give you one example. The JETS ETF, which is a sector ETF for the airline industry, 49% of that ETF is only in 4 stocks. So this isn't a rarity. This is across the board in many of the sector ETFs. One of the most popular ETFs to own at the moment is XLF, a financial ETF. It's also in a very similar situation where like half the money is concentrated in 5 stocks. This is almost the case with all sector ETFs. Half the money is just in a handful of stocks. In those cases, I would argue that if someone's putting a decent amount of money in one of these ETFs, they should just not. They should just forget about buying the ETF and just buy the 5 top stocks in it, because then they won't have any management fees at all, and they'll get a higher dividend rate. And in the long run, if it's all about escaping the fees, just buy this darn stock. So the ETFs aren't diversified. If half of the money in them is just in a handful, less than 6 stocks or 5 stocks, that's not diversification. And it's a giant illusion that ETFs are therefore a simple way to diversify. You got to know, you can't just look at a ticker symbol. You got to know, what is inside that ticker symbol. If it's an ETF, how diversified is it, and so forth. And I've made the move over the past couple of years to buy individual stocks more often than not, then if I'm investing, then just buy the ETF. So that's something to think about. But there's another thing about ETFs that I'm going to get to in a second, but that's even more important, that people aren't aware of at all, and causes a direct threat or danger, I think, down the road. Summary of what we said so far: rise of program trading with the few hedge funds dominating action, and the rise of ETF passive investing. Obvious implication of these things is a concentration of money in one real strategy. That's do this technical trading in the market with the hedge funds, and then we cut off at times, and that creates a buying pocket or a volume pocket, a liquidity pocket in the market. And then the rise of ETF passing, where many individual investors really have no idea what is actually inside the ETFs. And where this is a problem is what I'm going to show you in just So the Vanguard Total Bond Market ETF is the biggest ETF in the financial markets right now. More money in this ETF than any other ETF. It's got more money in it than SPY does and the triple Qs do, and it just invests in bonds. And people hold it, for diversification, thinking this is a safe way to be diversified outside the U.S. stock market. But there's a problem with this ETF that really carries over to other ETFs. And I'm not saying this is going to happen today or tomorrow, but it's a potential danger in the next couple of years. For U.S. stock market investors, this is the biggest danger in the financial markets for them if it were to happen. So, again, this ETF invests in government bonds, corporate bonds, municipal bonds. And if you've ever bought those bonds yourself, it's easy to buy them if you got a brokerage account, but selling them is a different story. If you go to sell a bond, you can't do it like you can a stock. You can't just press a button and have it sold within seconds. The broker has to find a buyer. And that's why in 2008 there's a problem with the mortgage market. Mortgage securities, there were no buyers for them. And that's what led to the 2008 banking crisis and crash. Well, if you look at the prospectus for this B&D bond, and this is it right here, you will see on it that there's a liquidity risk that they list, which says that the trading of this ETF may be halted by the activation of individual or market-wide trading halts. Now, why would that happen? Because although the fund's ETF shares are listed for trading, it is possible that an active trading market may not be maintained. Why? Because if the bond market were to go into a bear market and fall, like, say, 20 or 30%, fall enough to cause the people that own ETFs like this to panic and want to sell, and most bear markets end in panic, then this ETF this ETF probably would not be able to fulfill a mass amount of sell orders without being halted, because the securities aren't that liquid. Bonds really are not liquid securities. It's no problem as far as as long as the bond market goes up or isn't moving much, and it normally isn't. there's no problem, with this ETF, meeting sell demands at all. But if there's a bond bear market that culminated in like a 10% drop in one day or something, this ETF would probably be holding for trading. Now, I'm not saying that means it would go to zero or would be delisted, although it even says delisting is a possible risk. And we've seen the delistment of ETFs happen. That happened with some ultra short, VIX ETF in 2018. But I'm not saying that would happen with this. What I am saying is that individual investors really don't understand what they're investing in when it comes to ETFs. They don't know that a lot of these ETFs, half the money is in 5 stocks. They don't know that a bond ETF, if there was a bond drop in the bond market of like 10%, wouldn't be able to meet the redemptions in a timely manner. They don't understand that. And such people would panic. And I'm telling you this, so you shouldn't panic if you own this ETF or other bond ETFs that are all in the same situation, frankly, that got halted for a while. Don't panic. But realize that most people will panic if that were to happen, and it would cause other selling and other things and be a disaster. This is what I'm describing. I'm not saying it's going to happen next week, but this is the biggest danger in the U.S. stock market or the U.S. financial markets, a potential danger in the next couple years. And if there's a U.S. stock market and bond bear market at the same time, that's what it could lead to. Now, most American investors think the way to be diversified is have my money in stocks, have my money in bonds, and they use these ETFs. And that's okay. It's worked historically, but I do believe there will be a time when it won't work. And the way to deal with that situation is to understand that, think about it ahead of time, and you can, people can do various things. You can short stocks as a hedge. You can have cash as a hedge. You can diversify into other markets, other asset classes. There's all sorts of things to do besides just, own bonds and U.S. stocks, long both. And those are the things I talk about a lot and will continue to talk about. I just wanted you to understand the changes I've experienced in the markets, and what they mean is a lack of liquidity can occur in the markets. You can have trading robots turn off, creating a buying gap, and you can have people that don't understand how ETFs work panic someday in the future.